at 500 or 300 or at 1500 or at 1800 or 1900 who come to us really worry about the daily price fluctuations and a gold price influenced by a bogus LBMA market and a temporarily strong dollar.
And given, as you say, it's inevitable, why are we not seeing this sensibility, at least, reflected in the gold price? This idea is catching on, as you say. People are losing faith in the Fed. People are seeing how government is enforcing more and more controls. Why is this sentiment not being seen in the gold price yet?
Well, again, I think the gold price in the US dollar terms, that's purely based on the DXY and the relative strength of the US dollar right now, which is short term. I think also that there is, and again, it's not just the apology that we always use, but when you have open price fixing in the LBMA markets, the paper price of gold has absolutely nothing to do with the physical price of gold or the physical need for gold, the demand for gold. So I think those systems have to break first. The LBMA market has to either be contracted or outplayed by the Moscow World Standard, and the US dollar has to find its inevitable baseball up coming back to earth. It's going to happen. So I think right now, it's like saying, well, if it's rainy today, it's going to be rainy tomorrow. The fact that it's rainy right now in gold is only because the dollar is strong. That doesn't mean it's going to be rainy tomorrow. You have to be a long-term patient investor. And I think, again, to use a polo or a hockey metaphor, you always have to play where the ball's going to be, not where it is today. If the player in front of you does a backswing, you got to turn your horse towards the ball. Everyone is still looking where the ball is. I think investors in precious metals are already turning their horse toward where the ball's going to be. And I think they get the last laugh and the last goal at the end because they're seeing it play out. You have to think chess moves, not checker moves with precious metals. And people think that's an apology or an excuse for a low repressed gold price. I understand that. But none of the investors who bought at 500 or 300 or at 1500 or at 1800 or 1900 who come to us really worry about the daily price fluctuations and a gold price influenced by a bogus LBMA market and a temporarily strong dollar. And by the way, no, go ahead. I'm sorry.
So do you have an outlook that you feel comfortable saying? You're looking at the direction that the ball is going, where the puck is headed. Where do you see gold then in 10 years' time? What do you think is the fair value for gold? Or where can we expect gold to be at 10 years' time?
Significantly higher than this. I think, again, Ronnie Sturflid did a study recently, early in the year, where we were just looking at gold coverage, whether it was the M0 or the M4 money supply, and whether you had a 10% or 20% gold coverage. I think we'll have at least a 15% gold coverage on whether it's a new central bank digital currency or a Moscow World Standard or a combination of that chaotic thing in the mess in the middle. It's very easy based on a 10 or 15% gold coverage to see gold at the M0 supply at 5,000 and then the M4 supply at 16,000. That's conservative. When you talk about $50,000 gold, that gets headlines, but I think that's unrealistic. That would require 100% gold back on the US dollar as currently priced. That's never going to happen. But I think global currencies are about to go through an absolute shocking moment of destabilization, and that's going to have epic, unpredictable price swings in the gold market. But I think 5,000 to 16,000 in the next 5 to 10 years is totally appropriate. But again, that's being measured in increasingly weaker US dollars. Right. If you measure it in kroner or francs or pounds or yen, it's a very different conversation about the gold price. Right now, everyone's worried because it's so low in US dollar terms. But that assumes the US dollar is that polo ball or that hockey puck that never moves. And it's so clear that there's a backswing coming, that ball's going the other direction. It's just a question of when. And that could be 3 minutes, 3 months, or 3 years from now. I think it'll be sooner. I think it could be when markets hit unbelievable lows and panic, because gold is emotional. It can be high or low in strong dollar, weak dollar, disinflation, inflation. But when people lose faith in their currency, in their central bankers, in their politicians, left, right, or center, when they lose faith in their media, when they lose faith in their talking heads and pundits, and they feel it on the streets because inflation is palpable, when that collapse in faith occurs, gold prices rise, regardless what the LBMA tries to do or what central banks try to do. And I think that's the intangible, unpredictable reality of it. But we've seen that again throughout history, from ancient Rome to the Ming Dynasty to 1789 France. Gold is emotional. And when faith is lost, gold rises because there are no systems that can compete with it. And I think the faith right now in the US and Europe, being a European American, it's not confirmation bias. I'm seeing that lack of faith everywhere, from sophisticated to non-sophisticated, from investors to non-investors. The distrust of the conventional narrative is not a conspiracy theory. It's just not believing anymore. And I think that loss of faith will be the intangible, real tipping point. But again, there's so many needles pointing at this dollar bubble and at this market bubble and at this debt bubble. Again, 300 plus trillion in global debt when GDP is 1/3 of that is simply comical mathematically that we've gone this long. And the fact that we've had this many martinis without the proverbial hangover fascinates me, but I've no doubt that no one can drink 25 martinis without the hangover.
All right. Matthew, what's your favorite metaphor as we wrap this up? I'm gathering it's the martini hangover one.
Probably is. I think it comes down to that. Again, euphoria is great. And when you have those goggles on and you have too many martinis, everybody looks smart, everyone looks beautiful, everyone looks happy. But the hangover always breaks you reassess your decisions the day before or the night before. I think folks have to be realistic about the amount of monetary alcohol that this system has taken on and prepare for the hangover. And one of the bottles of water or one of the Bloody Marys you can take is precious metals as insurance, not as a gold bug, not as a speculation trade, but simply as insurance. It doesn't have to be all your assets. It's common sense to us. And the majority of our investors look at it that way. It's very boring, but very sensible.
Matthew, as you quite rightly said, every fiat currency has been debased. That is just the reality. And as you say, slowly, then suddenly, what is inevitable is not necessarily imminent.
Right.
But I'm going to put you on the spot here. What could be the tipping point that goes from slowly, then suddenly?
Well, it could be the changes in the derivative markets as rates rise and derivative markets contract or credit markets contract. I mean, the Federal Loan Officer Survey shows that credit is declining. The derivatives market is contracting as interest rates go up. Those are emerging markets could start defaulting on the US dollar because they simply can't stomach. They're stretched too thin to pay back those dollar denominated debts. So they either default or they look elsewhere. So I think any one of those three could be a tipping point. And there's always the unknown black swans, a political assassination, a breakout of some horrible extension of this war or something that we can't predict. But the system, the financial system, the banking system, the credit system, the monetary system is so fragile. The known or unknown straws that can break this camel's back are everywhere. It's like a bubble with a million needles pointing at it. And it's just a question of which one hits it. I can't predict it. I think the risk in the credit markets, I think the risk in the emerging markets, and I think the unsustainability of the US dollar are three obvious factors that could send this tipping point over the edge. The other geopolitical gyrations and movements are like currents in the sea, picking the right wave. It's hard to know which one that will be. But to me, it's as inevitable. It's as inevitable. And to time that is impossible. But I don't see how we can avoid this. Again, to use a metaphor, you can't have 18 martinis without a hangover. You can't pretend that you can solve a debt problem with more debt paid for with money created out of nowhere. That has ramifications. And the only thing that the central bankers and policymakers have done is buy votes and buy time with fake money. And I don't know how long that can last. But what scares me the most, historically speaking, from the 1920s in Spain and Germany and even in Italy, you saw what we saw in every moment in history. Whenever you have a country straddled by debt, you first see a financial collapse, a market collapse, a currency collapse. And this goes back to 18th century France, too. It happens every time, even in Batista's Cuba or in Venezuela or Argentina. Whenever you're debt strapped, you see this financial crisis, you see the currency crisis, you see the social unrest that always follows. And finally, you see extreme political centralization over your individual rights from the extreme left or the extreme right. And that, I think, is what's really scary, is what we're seeing. And again, that's a very political opinion, but there's so much evidence of governments becoming more and more involved in our daily financial lives, of which central bank digital currency is another example, because then you're monitoring your spending. But that's the tip of the iceberg to what we've already seen. I think that political shift to extreme politics and less individual civil liberties and rights and choices is a non-tangible, non-financial consequence of years of living beyond our means and using words rather than math, and using political talk rather than straight talk. I think any population would have respected a government that told them the truth rather than made up stories and excuses. And now we've gone too far. I think the real risk ahead is already being playing out since 2020. Less and less freedoms, less and less democracy, less and less natural supply and demand capitalism.